What would happen to your family financially if your paycheck stopped tomorrow and the protection you thought you had disappeared at the same time? Not next year, not at retirement, tomorrow. This question matters because income is the engine that keeps daily life moving. When that engine stops, bills do not stop with it. Housing costs, food, utilities, insurance, and education expenses all continue. Many families have never paused to imagine this scenario because it feels uncomfortable, but avoiding the question does not reduce the risk. It simply delays preparation. Millions of working families believe they are protected simply because their employer provides term life insurance. The truth is that employer life insurance often creates comfort, not security, and understanding that difference is critical. Employer-provided term life insurance feels responsible because it is easy. You enroll once, premiums come out of your paycheck automatically, and you rarely think about it again. That ease creates trust. When something requires no effort, people assume it must be sufficient. That convenience is exactly why it becomes dangerous. Employer life insurance is designed as a workplace benefit, not as a comprehensive family protection strategy. It is not personalized. It is not structured around your mortgage balance, your children's ages, or how long your family would need support. It is built around administrative simplicity and broad averages. The first major problem with employer term life insurance is how coverage amounts are calculated. Most employer plans offer coverage equal to 1 times salary, sometimes 2 times salary if you elect additional coverage. That sounds reasonable until you slow down and apply real-life math. 1 year of income does not eliminate debt. It does not pay off a home. It does not replace income long enough for a family to recover and reorganize their lives. Financial responsibility does not disappear after 12 months, and protection should not either. This is where illustration 1, employer life versus proper term life, becomes important. In this illustration, employer coverage is based on a salary of $80,000, resulting in only $80,000 of life insurance. That amount may cover funeral expenses and a few months of essential bills, but it stops there. Proper term life insurance is calculated differently. Instead of asking how much someone earns, it asks how much the family needs to live. Annual expenses of approximately $37,500 multiplied by 20 years results in $750,000 of coverage. This approach is logical, measured, and grounded in reality. Employer life insurance uses salary multiples. Proper term life insurance uses income replacement math. The second major issue with employer term life insurance is portability. Employer coverage is tied directly to your job. If you change employers, get laid off, retire early, start a business, or experience a career interruption, the coverage often ends. This creates a hidden vulnerability. The moment income becomes uncertain is often the same moment life insurance disappears. Protection should be strongest during transition, not weakest. This reality is clearly shown in illustration 2, job change risk, and it highlights one of the most misunderstood weaknesses of employer life insurance. In this example, employer-provided life insurance offers $120,000 of coverage because it is calculated as a multiple of salary. That amount exists only as long as the person remains employed with that company. The coverage is not owned by the employee. It is tied to the job itself. If the employee resigns, is laid off, changes careers, starts a business, takes time off, or is affected by corporate restructuring, the life insurance coverage usually ends at the same time the paycheck stops. This creates a dangerous overlap of risk, where income loss and protection loss happen simultaneously. In contrast, an individually owned term life policy is designed around the family's financial needs, not employment status. In this illustration, the $1 million coverage is calculated by determining how much money the family would need each year to live and for how long they would need that support. Replacing $50,000 per year for 20 years results in $1 million of coverage. This approach focuses on stability rather than convenience. Because the policy is personally owned, it stays in force regardless of job changes, layoffs, career transitions, or business decisions. The family's financial protection does not depend on an employer, an HR department, or company policies. It depends solely on a deliberate decision made by the individual to secure long-term protection that follows them through every stage of their career. Another overlooked weakness of employer life insurance is lack of control. Employees do not choose the insurance company. They do not control underwriting rules. They cannot customize the length of coverage to match their real financial obligations. Everyone is placed into a group plan designed for averages. Proper term life insurance allows families to design coverage around real timelines such as mortgages, child dependency years, and long-term planning goals. Cost is another area where misunderstanding is common. Employer life insurance often appears inexpensive because employers subsidize part of the premium. However, many employer plans increase in cost as you age. Premiums may rise every 5 or 10 years, quietly becoming more expensive when budgets are already tight. Individually owned term life insurance locks in a level premium. The price you agree to today remains the same for the entire term, providing predictability and stability. This concept is illustrated in illustration 3. Weighting increases cost. The key point is that we are comparing the same product, the same coverage amount, and the same purpose, but at 2 different ages. The illustration uses a $1 million term life policy because it is a common round number for income replacement. At age 30, the monthly premium is approximately $48, which equals $576 per year when multiplied by 12 months. At age 45, the same $1 million policy costs around $145 per month, or $1,740 per year. That is an annual difference of $1,164. And over time, that gap becomes significant. The reason this happens is simple. Insurance pricing is based on risk. As age increases, the probability of health issues and early death increases, so the insurance company charges more to provide the same benefit. Nothing about the coverage changed. The death benefit is still $1 million. The term length is the same. The only change is that time passed and risk increased. This is why delaying term life insurance is expensive. It is also why relying on employer life insurance is risky, because employer plans typically do not lock in pricing the way an individually owned level term policy does, and they do not protect you from the cost jump that comes with waiting. Another silent risk of relying solely on employer life insurance is future insurability. Delaying ownership assumes health will remain unchanged. In reality, health can change unexpectedly. Once it does, obtaining affordable coverage becomes harder or impossible. Employer plans do not lock in health ratings. Personally owned term life insurance does, preserving access and affordability while health is strong. Employer life insurance also fails to recognize the full economic value of a household. Many families rely on unpaid labor such as childcare, caregiving, and household management. These roles have real financial replacement costs, yet employer life insurance only insures income tied to a paycheck. Proper term life insurance allows families to protect everything that keeps the household functioning. This is demonstrated in illustration 4, income replacement reality. In this example, annual household expenses are conservatively estimated at $65,000 per year. This figure represents the true cost of maintaining a household, including housing, utilities, food, transportation, insurance, childcare, and basic lifestyle expenses. It does not assume luxury spending or inflated living standards. When those essential expenses are multiplied over a 20-year period, which commonly reflects the time needed to raise children or pay off a mortgage, the total income replacement need reaches $1.3 million. This is the amount required to allow a family to continue living with stability rather than scrambling to survive. Employer life insurance rarely approaches this level of coverage because it is capped by salary multiples rather than real financial needs. As a result, families are often left dangerously underinsured, believing they are protected, when in reality, they are exposed to long-term financial strain disguised as short-term coverage. Search behavior reflects this confusion. People search phrases like employer life insurance versus individual term life insurance. Is employer life insurance enough? Affordable term life insurance, income replacement insurance, and life insurance for parents. These searches exist because people sense a gap. Education fills that gap. Proper term life insurance is not about fear. It is about ownership and control. Employer life insurance can supplement protection, but it should never be the foundation. A strong foundation is a personally owned term life policy designed around real expenses, real timelines, and real risks. The most important question is not whether you have life insurance. The real question is whether your family would still be protected if your employer were removed from the equation tomorrow. If this explanation brought clarity, make sure to like this video, subscribe for more real financial education, and stay connected as we help families build protection, stability, and peace of mind.